30 days ago, I stopped backtesting. Instead, I gave my AI trader a live 100,000 demo account and let it trade the real market. No cherry picked trades, no editing out losses, just 30 days of live execution. Today, we are opening the entire trading journey, the wins, the losses, the bugs that almost broke the system, and whether the AI trader is actually getting closer to passing a prop firm challenge. Let's find out. After 30 days, here's where we stand. The account started with exactly $100,000. Between June 4th and June 30th, the bot placed 25 trades across three currency pairs. The final balance $101,071. That's a profit of 1071 or just over 1% for the month. The win rate came in at 56%. Gross profit was $3,048. Gross loss was $2,337, giving us a profit factor of 1.46. Now, those numbers looks positive, but numbers alone don't tell the story because behind those 25 trades were several mistakes that backtesting never revealed. Let's break down the performance by currency pair. GBP JPY was easily the strongest performer. 7 trades, 5 winners, profit factor of 3.89%. Total profit 784. Everything worked exactly as expected. The strategy was clean, the exits were clean, the risk management behaved exactly the way we designed it. Euro USD carried most of the workload. 14 trades, 8 winners, profit of $611. It made money, but there were more stopouts than I'd like. Finally, Euro JPY. Only 4 trades, 2 wins, 2 losses. But those 2 losses completely erased everything that pair had earned. Overall, GPP JPY gave us confidence, Euro USD gave us consistency, Euro JPY gave us problems. If there is one thing June taught me, it's this: backtesting tests strategies, live trading tests software, and June exposed bugs that no historical simulation ever showed. The first issue was the MT5 connection. Every night at midnight, the bot disconnected from MetaTrader. The next morning, the market scanner couldn't communicate correctly, so it simply returned a void. That meant valid London session trades were being skipped without me realizing it. The fix turned out to be surprisingly simple. The bot was running under Windows system permission. Changing it to administrator completely solved the issue. The second problem happened on June 12th. Two trades had to be closed manually. The execution logic couldn't handle those market conditions correctly. Those trades remain in the journal, and the logic will be rebuilt before moving forward. The third issue was the SMA crossover exit. Instead of allowing trades to reach either stop loss or take profit, the strategy sometimes exited early. That rule has now been removed completely. Finally, Euro JPY. Two stop losses within 4 days, a combined loss of more than $800. The strategy clearly doesn't behave the same way on this pair. That isn't something to ignore. It's something to investigate. And that's exactly what we'll be doing. The good news, every one of this problem happened on demo, not on a funded account, not with real money. That's exactly why we test first. Now let's talk about risk. This is the equity curve for the month. No massive crashes, no emotional recovery trades, no panic, just steady movement. The worst day of the month came on June 22nd. Two stop losses, one on Euro GPY, one on Euro USD. Total loss $625. That's roughly 0.6% of the account. At no point did we come close to the violating a prop firm's 5% daily loss rule. The risk engine did exactly what it was designed to do. So, was month 1 successful? Yes, but not because of the profit. The profit is almost secondary. The real success is that we finally have live market data. We now know which parts of the strategy are strong, which parts are weak, and which parts simply don't work in live conditions. 25 trades are nowhere near enough to validate a trading system. One profitable month proves absolutely nothing. What matters is consistency over hundreds of trades. That's why the bot keeps running. Month 2 starts now. Before we finish, I want to thank one of you. After episode 10, at Life of Titan 8, left a comment suggesting something that immediately caught my attention. Instead of using fixed stop losses and take profits, why not let volatility decide? Using ATR based dynamic stops. It's a fantastic idea because fixed pip losses are becoming one of the weakest parts of this strategy. So that's exactly what we are building next. In episode 15, we will backtest dynamic ATR stop losses against the current fixed version. Compare every metric and only keep it if the data proves better. No opinions, just evidence. I'll see you next Sunday.